Hey, Romeos.
Hey, Romeos.
Hey guys, welcome.
And
Still well.
still well.
And
Welcome to World Romeo
There are some who may
headquarters.
want to debate that, but we're on your side.
Yes,
Still well.
yeah.
Thanks for joining. Thanks for liking and subscribing. We love you. We want you. And motherhood, apple pie. Let's get this
What
shit
about
rolling.
jet lag?
Coffee.
bit?
Lots
Little
of
bit?
coffee. Lots of coffee.
Lots of coffee. Good.
Traveling Romeos, eh, Nuran?
There you go.
The jet
Always.
setter.
There we go.
Always. So,
So here we are.
In honor of Nuran, who has a love affair with the financial market.
Oh, yes.
Or is losing his shirt.
I thought we'd talk about whether or not we are in a bubble.
Yeah.
Take notes, folks.
a booble?
Bubble.
A booble. Okay.
A specific bubble or just
An
bubble?
AI bubble, perhaps.
Enlighten that so great investor.
Oh, great investor. God help me.
Or the rest of us.
The great gazoo of investing.
Yeah,
Well,
exactly.
this is your idea, right? This topic?
Déjà vu. No? For those of us who in the late 1990s
Yeah, the .com stuff.
started scratching our heads because people who knew nothing about investing were talking about how much money they were making. And
Oh yeah, it was so easy. It was so easy to make money. All I had to do was put money in the market, and it grew. It just grew. It was by magic.
well, the same has been true for the last little while.
Yeah. Well, a little while. That's the thing, guys. I mean, the last time the markets came down were in 2008, right? So since 2009,
You've been on a tear.
Well, you're kind of skipping over COVID,
yeah.
but
COVID, it was a blip. It was like a year and a half
it's a year and a half of difficulty for many people.
of a pandemic, for God's
Yeah.
sake.
Okay.
But besides that, I mean, from a financial perspective, from a non-pandemic based perspective, we've been in
Okay, but
in
there's
prosperity.
always, it seems, an event that triggers,
Yeah.
I'll say, either a significant market correction
There hasn't been one
or a collapse. There hasn't been in a while.
in a long
So
while.
you wouldn't count the effects of the tariff war back in February?
No.
No.
Minor.
Minor?
That was minor.
Minor.
Well,
Okay.
When you look at year to date, we're up over 20% in most markets.
Yeah.
Right. So even
That's
now,
why we're happily retired.
Okay, but guys, so let's separate a couple of issues. Can we agree that 15% or less of a correction is a correction? More than 15%, we start looking at something more significant. And if we're getting a 25, 30% plus, we can call that a crash.
Yeah, 30.
Is that fair?
30
Yes.
plus, 30 to 40. Yeah, that's a nice little.
That's a crash.
Yeah, that's a nice one. That's good.
Yeah, I think 25.
Those do not occur very often. The corrections will happen much more
So
frequently.
what was COVID?
Yeah. Well,
COVID was more than a correction,
Yeah.
but it recovered so.
but it
quickly.
recovered very quickly.
Yeah.
I mean, just so quick. It was like it was a flash crash and a flash recovery.
So it wasn't structural.
So it wasn't insignificant.
It was just an
Okay,
event.
so if we agree on
Yeah, we do.
correction versus crash,
Yeah.
yeah.
let's now talk about a bubble. What constitutes a bubble?
Irrational exuberance.
Yeah.
So, and how
As someone used to say.
what are some of the signs, if you will, that lend credence to the fact that you may find yourself in a bubble?
Oh,
Price earning ratios that are out of whack?
No, well, I'll go even much simpler than that. Any company that posts any press release that has the two letters AI in it, all of a sudden.
Okay, you're
there's-
talking specifically now. I'm talking in more generic terms.
Well, I was being
When we have a
generic.
bubble, but AI is it's like saying .com. Well, that's no longer true. But in the late 1990s, any company that said .com or internet saw its valuation balloon.
Yeah, and that's happening now with AI. So
But I think Aki raises a valid point, which is one of these signs would be valuations that are based on price earnings multiples that are well beyond what is normally acceptable.
yeah, I think the S&P is around 27, 28 now.
Holistically, but then you look at
Tech.
the
Nvidia, right?
small number of businesses that are largely responsible
Yeah.
for that average being at 27, 28.
Yeah, it's probably 50, 60, 70 for those guys.
I mean, we're more in some cases.
Or more. Yeah, exactly. It's crazy. The multiples are crazy. The spend right now is crazy because of the AI direction that everyone's taking. The amount of fluctuation in stock prices based on press releases that have nothing to do with today but are far forward looking with respect to when some of these changes will be implemented and when you could look for a return on investment on some of these things way out in the future, 2, 3, 4 years in the future, discounted to present value, are still adding crazy amounts of valuation.
So you're of the opinion that we are in a bubble.
I think so. I definitely think that it's a self-feeding bubble for now because of all the money that's being spent.
But it's a bubble.
I believe so. 100%.
Dominic?
So.
I think we're in a bubble, but not across the board. I think specific industries and specific companies, there are bubbles, but not across the board. That's, I think, for example, some companies, yes, AI, but some companies, the AI is just a portion of their business, like Amazon, Google. It's not their whole business. So I don't think...
but there's a large...
But then you have to look at the valuations for those businesses and ask yourself whether, and I'll use a simple example of P multiple, which is not the only meaningful indicator, but it's an indicator. Is that a reflection of what you would expect an online business, online commerce like Amazon to be valued at? Or is it disproportionately high because of Amazon Web Services and now AI being tacked on to Amazon Web Services?
But I think what investors are thinking or putting in their calculations is the efficiencies that will come from AI.
So it's interesting because you're using the term investors, and I'm going to disagree with you.
Wow.
I think relatively speaking, very few investors are actually doing the groundwork to determine what they should be investing in and what kind of returns they should expect.
He should be saying traders, not investors.
What I see are a whole bunch of sheep who really don't have a significant financial acumen, that are looking at the trends or looking at what people are saying online and various sites and saying, oh, here's something that seems interesting. I'm going to dive in.
Well, see, I'm looking
Sounds like crypto to me.
Last week,
highly speculative.
You had Amazon and UPS that announced tens of thousands of layoffs, and the reason they gave was AI. So that's efficiencies that they're...
Well, it's efficiencies. It's also strategic in that the CEOs and CFOs of companies today are being very careful to integrate language in their press releases that gives some indication that they are incorporating AI into their businesses in a way that's going to drive productivity increases, efficiency increases,
That's what I
earnings
said earlier.
improvements.
Yeah, good marketing.
Yeah.
You put AI into any press release, and all of a sudden you get a 5% bump in your stock price the next day. That's what I'm saying, and it's either because they're gonna spend money. So now you have companies that are saying, "Oh, I'm going to spend $100 billion on AI, and to increase my AI spend by tens of billions of dollars," and the next day their stock price goes up.
So
It's amazing.
So also
the
you
expected
need,
return on
but we need to make a
investment.
distinction between businesses that exist for the sake of developing the underlying infrastructure, the plumbing, if you will, that is going to enable this AI revolution, versus businesses that are leveraging AI-based technologies to render themselves more efficient, more productive, and so on.
And as well, businesses that have AI as a service. That's the other one. So
Sure.
Those are the three layers, basically.
And so the companies that are involved in the plumbing, the bricks, the mortar, the infrastructure, and the ones that are providing AI as a service are being much more richly rewarded
Yes.
in terms of valuation.
Yeah, because this is it's more easy to see the to expand or to look at their business and say AI is going to be able to positively affect their business immediately because there's a revenue associated with it. So NVIDIA and all the guys that are putting the plumbing in place or the chipsets in place, AMD and so on, they're getting orders now. So they're making that money now, and they've seen their valuations go up. The second tier of that are the guys that are going to be providing AI as a service. So the open AIs and Anthropics and Google to an extent and all these other guys, XAI and so on. These guys are spending the money but they haven't gotten the return on investment yet. This is a
well, and the question is, will some of them ever get?
that's where I was getting at, right? So the third layer is the companies that are going to use AI to make their companies more efficient and lay people off, and therefore have.
But that to me is much more straightforward.
But that's also going to take more time.
Perhaps, but in simple terms, I would look at any business today that operates at a profit. And I know for certain that AI will be incorporated in how they do business moving forward.
Yeah. So 10, 15, 20%.
And if they do a good job of incorporating and leveraging AI, their businesses are only going to get more productive and more efficient. And if they're good businesses today, they're healthy businesses today, I expect them to be healthy in the future. And so I expect a reasonable return on the investment I make in those businesses.
Okay.
I don't see that as being highly speculative.
Okay. What percentage would you give that category off the top of your head as an increase in general?
As an increase to
increase in their valuation, how would that the increase in the earnings potential?
So I go back to a standard that I will use, and whether I'm on the mark or off the mark, I don't know, but it has prevented me from making serious mistakes or getting overly optimistic about the kind of performance my investments might generate. I would say that anywhere from 8 to 10% annualized is a good number.
Okay.
Okay. So if I can see an 8 to 10% return annually sustained, right, compounded year after year after year, then 8 to 10% means that every 8 years or so, I'm going to double my money.
Well, it also means that the stock market's rise, 8 to 10% of it has been explained by what you just said.
Which is reasonable.
Exactly.
That's not the issue. The issue is when people grow accustomed to 20% plus returns that's year after year after year.
That's why I said.
And by the way, that 20% is a number that reflects a large number of businesses that are providing minimal to negative returns.
Yeah. With shitty balance sheets.
And those who are providing returns that are literally astronomical.
Right? So if I can extrapolate from what you said, and the reason I asked that question,
there's no bubble.
Well, no, 10% of the increase.
It's reasonable.
There is a bubble, I believe. Well, I believe there is a bubble.
Even with
markets are up over 20%.
Yeah, if you look at the average today multiple, it's at a historical high, and people can use arguments such as, yes, but. It's a function of improvements in productivity, efficiency, lower interest rates, yada, yada, yada. Okay, that justifies some of it, but it doesn't justify the full extent to which we have seen the multiples.
So markets are up. But markets are up 21%, more or less. Is that what
but you're talking about the multiples, and I agree. If a multiple of 18, let's say historically is right for the S&P, and you add 10%, it should be at 20, 21, 22.
But even if you do it,
28,
even if you do it by industry,
which is where it's at.
So if you look at established, right, so old school financial institutions that generally were trading at a 5-6% multiple and are now trading at a 12 to 15% multiple. These are old banks. This is not like fintech at its finest. These are old banks, right? Is there a justification for it? Some may argue yes, some may argue not. Yeah. But I'll tell you what. At a 12 to 15% multiple, I don't lose sleep over it.
You mean times multiple?
They're paying the times multiple. They're paying a healthy dividend for the most part, right? There is an appreciation that is justified based on their earnings improvements. Yeah. So I don't lose sleep over that.
No, exactly. But that's.
But when you look at companies that have yet to generate any profit,
exactly,
and that are being valued in the multiple tens or hundreds of billions of dollars. Or companies that are in the hundreds of billion to trillions of dollars that have a business model that while impressive, doesn't begin to justify that kind of valuation.
And what we're seeing is that these are the companies that are having more weight in the market.
Yeah, exactly.
Well, of course, because if they're worth trillions of dollars, there aren't that many businesses that are worth trillions of dollars.
They're not necessarily strong businesses.
Well, no, some are. Some are very strong.
Most of them have amazing balance sheets because they've been doing this for a while.
So most of them. So what is our concern?
Okay, let's take the poster child. Let's take the poster child. So, and I want to draw some parallels with what happened in the late 1990s. So I'm going to take NVIDIA. Is NVIDIA a great company? That's a short conversation.
Yes.
They're a phenomenal company.
Yeah.
is NVIDIA going to benefit from the AI revolution more than
Yes.
any other company on the planet?
Big time.
In all likelihood, yes. Right? They're leading the charge.
It'll be one of the top 2 or 3.
Of the categories we named before, what category do they fit in?
They're the infrastructure, the plumbing.
Okay. Does that sound an awful lot like Cisco in the late 1990s?
Yeah.
What happened to Cisco?
How about Nortel?
Yeah, well, that was more the fiber slash, yeah. But yes, they were in there too.
So what did happen to Cisco?
Well, Cisco at one point, and some people forget, was the most valuable company
On the planet.
on the planet. In the late 1990s,
Yeah.
they had the highest market cap of any company on the planet.
Okay. And NVIDIA now is in that role.
NVIDIA is worth over depending on the day,
Okay.
$5 trillion.
Okay.
Yeah.
So,
Crazy.
Trillion.
Yeah.
so
1,000 billion.
okay. So whatever happened to Cisco, what are the possibilities of the same fate happening to NVIDIA?
I would argue quite strong.
And so
Oh,
did
wow.
someone else recently, I guess.
Wow.
Yeah.
The Big Short guy, is that it?
Yeah.
Yeah. Berg, what's his name?
I don't know.
Yes, it's
Never mind.
Michael
I thought Berg was-
Boulay, I think.
Oh, okay.
Not
No.
Boulay.
Okay.
Okay. Oh, wow. So this is
Yeah.
So you've got these companies that are in a circle jerk in a sense because everyone. Well, I
No, so
I say that for a reason. It's circular.
just keep your hands above the table.
it's a circular economy.
Exactly. Then that's why I mentioned the circle jerk because you've got all these companies like OpenAI, for example, has just made multiple announcements or has made multiple announcements over the past several weeks and months with multiple players, where it's AMD, whether it's NVIDIA, whether it's with Broadcom.
Okay, but let's stick with our NVIDIA
With Amazon.
example. Let's stick with our NVIDIA example.
Okay.
And my numbers may not be exactly in the mark, but again, I'm going to draw some parallels.
Sure.
So, for the sake of argument, what is circular economy? So NVIDIA invests $100 billion, say, in OpenAI. Okay, now you say $100 billion is a lot of money. They're worth $5 trillion. So yeah, they put $100 billion in OpenAI.
Mm-hmm.
Why do they give them $100 billion investment? To give them the ability, the capital needed to make the investments required by OpenAI to bring their technology to the next level and the next level and the next level.
It uses.
But in order to do that, they need to leverage GPUs, right, that are manufactured by whom?
Mostly NVIDIA.
Mostly NVIDIA.
Yeah.
So I'm investing $100 billion in your business so that you can buy over $100 billion of my technology.
Yeah, you're investing in your customer.
So companies like, I'll stay away from Cisco. They did it, but not to the same degree that, say, companies like Lucent and Nortel may have, where they would essentially give their customers unlimited lines of credit so that they can buy all this fiber from them so that they can build the
Fiber transport.
fiber-based highway to enable the internet in the late 1990s and early 2000s.
Very sweet.
Teleglobe and those
Right?
guys. Yeah. It was WorldCom, if you remember.
of course.
All those guys.
Now,
yeah.
some survived, but so Cisco survived and they're a viable business today. They're a very good company, but they're no longer what they once were.
Yeah.
But Nortel's gone.
Yep.
Lucent is gone and broken up into
Everyone-
fragments.
Yeah.
WorldCom is gone.
Yeah.
Many of the companies that were the poster child
Global
for the
Crossing.
internet are gone,
Yeah. All those guys.
or very small versions of what they once were if they survived.
Yeah.
The same thing in my mind is going to happen with AI. All these companies cannot be winners.
No, exactly.
Some will win, many will lose,
Yep.
some will survive, many won't.
And the fallout is going to be enormous because think about all the spend that's going in, the data centers that are being built, the power that's being used, all of this stuff costs money. There's a return on investment that's required on all of these investments. And the return is multiple years out. If that doesn't come to fruition, if all of a sudden an AI service on your cell phone becomes the expected norm and no one is willing to pay for it, or if they're willing to pay for it, the ARPU, the average revenue per user only goes up by 5, 10, 15, 20% and not 500%, then there's not going to be incremental revenue available to support the investments that were done in the past. If that happens, yeah, there's going to be a sucking vacuum sound as the market just falls to the ground, because people are going to realize at that point, holy shit, these billions and trillions of dollars were spent on these enormous data centers and there's no revenue coming out of this thing. Who's making a revenue? Someone's got to make revenue out of this thing as a service. And
Well, somebody's got to make revenue.
a lot of it.
And over time, more importantly, somebody's got to make a profit.
Well, and that profit
Because
is years down the
you
road
are
because
gonna
of the
have-
investment.
Right. Many years down the road.
Yeah, and that's my
So, but
100%.
you do have businesses today. So I'll use a couple of examples. Meta,
Mm-hmm.
right? Known to some as Facebook. Alphabet, known to some as Google.
Yeah.
Who have legitimate, well-established,
Existing
highly profitable businesses today.
Exactly. Yep.
And while they're throwing tens or hundreds of billions of dollars at AI, they can do it.
Yeah, they can afford it.
They're self-funding.
Their balance sheets are amazing.
But also,
many of the early stage companies that are investing in AI cannot.
okay, but to your argument, Nuran. So as these data centers, more of them are established.
Yep.
Won't the costs? So I mean, won't the profit margins go up because the costs will be
Wait,
lowered?
profit margins for who?
I mean, the people that will be using the data centers.
Well, so okay.
No,
so,
using them?
So hang on. So when you build a data center, you need the infrastructure, so
Right.
the chipsets and
Right.
everything.
Right.
So the people who are building the data centers are making NVIDIA and AMD and other
Right.
chip providers. Those guys are making the money now.
So the beneficiaries, let's be clear.
Immediate
First of all,
beneficiary-
what are you doing? You're buying land. Okay?
Power.
You're putting up buildings.
Yeah.
You're filling the buildings essentially with infrastructure gear.
Servers, right?
Servers. Exactly.
So at the
Right.
core of those are highly powerful next generation chips
Right.
that enable
Right.
the AI.
Right.
Yeah.
And you have to have all of the latest technology with respect to
Connectivity, Ethernet switches,
networking,
all of that stuff.
transport, communications, and so
All
on
of
and
it.
so forth. So,
Storage.
so
you name it.
you literally have a handful of companies
Yeah.
that are the primary beneficiaries. When I say primary, a handful of companies represent probably 80% or close to 80% of all the revenue associated with what we've just described.
Right.
Yeah.
Then you need power. Right? So think of the amount of hydroelectric power or
Right.
energy, broadly speaking, because it's not just going to be hydroelectric.
No, it
Right.
can't.
That is nuclear and other that you're going to
Exactly.
require
Yeah.
in order to power all of this
Yeah.
and to cool it.
Yes.
These things run hot.
Yes.
Yeah.
Yes.
Which is why some businesses are being established in cooler, more northern climates.
Okay.
Exactly.
Right? Iceland and so on.
Okay. So what I'm saying is.
So the hundreds of billions of dollars that are being invested in building the capacity from which then you will be able to lease.
Yes.
Right? So offer your
Yes.
product as a service, if you will. That's a big bet.
No.
So right now the beneficiaries are the infrastructure guys. Right now, this
Right.
moment. That's why
Right.
NVIDIA has a $5 trillion plus.
NVIDIA, AMD, Broadcom, all these businesses.
Exactly, because right now they're the ones that are actually supplying the stuff for it to get built.
Right.
Now,
Right.
and then what they're doing to ensure that they're riding this tidal wave is each of them in a slightly different financial structure is it's essentially giving money to their clients,
Yeah.
Yeah.
either by way of an investment
Yes.
or by way of credit or by way of exchanging equity in their business for revenues.
That's the circle jerk part.
Each of them is doing performing these acts that are not typical in business.
No.
Okay, let's understand that this is not typical business. To give their clients the capacity
Yes.
to buy
Incentives.
their high-powered, expensive,
Because they're not making
Technology.
any revenue from it yet. That's the problem.
and they won't.
Well, that's the whole question: is can the revenue ramp effectively to the point where it would justify all of this investment?
The revenue will ramp more quickly than the earnings will ramp.
Yes, of course.
So revenue will come in. So
That's an of course statement.
these companies will be able to say, but we've tripled, quadrupled our revenue, quarter over quarter, And so the investments are paying off.
What are your operating earnings?
But they will be operating at a loss for as far as the eye can see.
And that's where the bubble. I mean, this is what the bubble is going to be. But it's only going to be seen in, let's say, 2-3 years from now, when these companies are going to be giving their quarterly statements, and people are going to be expecting some sort of earnings from them. But at that point, they'll still be spending, saying, no, but we got to spend more because our competition is spending more. So it's like a spending bubble right now.
So if you're
That's
a
where we're
Meta or an Alphabet,
you can afford that.
and you've made some bad decisions and bad investments, you'll write them off.
Yeah.
And you'll have a terrible quarter, and then you'll tell the public it's behind us.
Yeah, look at
We're moving
Meta
on.
with their Meta universe or whatever, the metaverse bullshit that they spent, but I don't know how many billions of dollars on that.
Well, certainly in the multiple tens of billions, if not more.
And then nothing happened.
So they write it off, they take a hard right, and they go in a different direction. And Alphabet can do the same thing.
Yep.
Right? Because they got these cash cows that they rely on day to day. Microsoft, same situation. Microsoft can afford to make a bad decision or two. They'll be okay.
Yeah, exactly.
But I think the expectations that have been created around some of these young startups, and similarly around some of the infrastructure providers, have gotten ahead of themselves. Yeah. So in my opinion.
Okay, data centers by themselves have the potential to become very profitable, do they not?
Well,
it's not the question. The question is, are we going to have overcapacity at some point?
Yeah, okay.
In other words, all these data centers that are being built, are we going to fill them all? And the AI, many of the AI proponents are going to tell you, absolutely. In fact, we don't have enough capacity.
There you
we need
go.
more and more and more.
I agree that they will be filled up. The question that I have is, will the revenue that they make off of the services that they're going to run on the data centers justify the building of the data center?
Okay, so
that's where my problem lies.
Okay, so my thinking on this is, if you build the infrastructure, you build a lot of infrastructure, you invest heavily, as we explained, right? Your operating costs at some point will come down.
So let me explain it in a different way. You build a data center, and that data center has a certain ability of a certain amount of compute ability that you're going to now sell to other people.
Correct.
Right. So you sell this compute. Right now you build a data centers because you have a demand. So you build this amazing data center, and you can sell every little teraflop of whatever of capacity that you have.
Yes.
The people that are buying that capacity are trying to make money off of what they're selling because they have a service that they're selling off of this thing.
Right.
If that service doesn't make enough money for them to be able to pay you for that capacity, they're going to go out of business.
Okay.
And now all of a sudden the demand on your data center is not going to be there. So all of a sudden you had humongous demand because everyone wanted a piece of that thing to sell a service. 5 years from now, no one's making money from any of the services. Your demand's going to go down. You're going to have empty data centers.
Okay, but
that's what's going to happen.
What are the projections? I mean, these projections, like these companies, that want to tap into the data centers, they must have projections.
Of course they do, and all the projections are going up like this because of AI.
Yes, but if you're Microsoft, or your Alphabet,
and that's not reliable,
or your Amazon with web services, or your Oracle, or you're one of the companies that is essentially in the cloud service computing business today,
they'll be fine.
They're just continuing to invest in a business model that is already lucrative for them.
Correct.
Okay.
Right.
But others, who are just getting started, and betting their entire future on the demand outstripping what the companies I just named can service. That's a riskier proposition.
That's a dangerous proposition.
That's why I believe that the bubble is not across the board. It's individual companies, individual maybe industries, but not across the board.
But that's generally true of bubbles.
Yeah.
How was the .com bubble any different?
No, for example, like Google is an AI, but I don't think there's a bubble with Google.
Well, they have their own issues with search.
But Alphabet is not trading an outrageous multiple.
True.
They're already a well-established business. They generate revenues. They generate earnings, positive earnings.
Exactly.
Can they continue growing those earnings? Time will tell.
Yeah.
But because they have a legacy business and AI is going to change everything, one can argue their legacy business is at risk.
Yeah. Their search, for example.
Okay. Yeah. So exactly. So when OpenAI, who for those who don't know is essentially ChatGPT, that's OpenAI, when they say that they're in the search business now they are in the search business. If you're Alphabet, you're thinking, my Google business is probably going to be under more serious attack than it has been to date.
But they have no version, so.
Yeah, but Gemini is shit compared to ChatGPT in my perspective, from my perspective.
Okay, so you raise another interesting point. There's a lot of discussion today about who has the best AI.
Yeah.
I don't think it matters because we're such early days into the development of AI. I mean, it does matter in that there is an arms race going on, right? So that matters. But the early leaders...
The reason why I say that is because Gemini is so bad.
Gemini is Microsoft?
Okay, no,
it's
Gemini is
Google.
Alphabet.
Oh, Google.
But
It's just so bad.
forget Gemini.
Yeah, it's. I have to because I
Just
can't
like
rely on it.
forget Gronk AI. Forget...
Oh, okay. Musk's.
My point is, it's such early days. We don't know. Every time there's been a technological revolution,
Yeah.
the early leaders have rarely been the leaders over the longer term.
Yeah, that's.
Can you even name the internet browser companies that dominated the 1990s?
AOL.
Netscape,
What happened to them?
none.
Okay.
Just ask Jarvis.
Yeah, just ask Jarvis. Yeah. Right? So the true innovators, the first out of the gate, are rarely the ones who win the long game. The other thing I would suggest is all of our conversation to date,
Is being recorded. Oh, sorry.
you are correct, is being recorded, has centered around American businesses.
Yeah.
The Chinese are right there with AI.
Oh, yes.
Now,
Big time.
when I say right there, I don't have inside knowledge. But if you think for a second that the Chinese have not been investing dollar for dollar with the Americans to either keep pace
Absolutely.
or to surpass them. And in
definitely.
fact, if I'm not mistaken, very recently, the CEO of NVIDIA,
Yeah, he just said it exactly.
right?
Yeah.
He said it in an interview and then he started walking it back.
And he would know.
Exactly.
He would
He was
know.
walking it back?
Yeah, he started walking
Well,
it back
because the
people
backlash-
freaked out. Exactly. So, yeah, he was saying that China's ahead
China's
of the
ahead,
US.
yeah.
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 I think it is.
Well, in fact, we don't know. But let's understand that this is not a one-horse race.
Well, they got 1.4 billion people that they've done face recognition and movement recognition for the past several years.
Oh, because
so,
the AI, it's not about the programming. It's about data. Let me tell you, Chinese have data because
It's learning, yeah.
there's no privacy concern as there is here. So people have shared our data, and that's what it is.
Well, whether they willingly share it
Yeah,
or not,
Okay.
Yeah.
it's the world's data.
well, the NSA also doesn't give a
Yeah.
shit about it.
Right.
They're listening too, so.
So, yeah, I mean, your point is
Virginia.
well taken, but I would argue, Dominic, that in any bubble, there are a few industries and few companies that are responsible for the bubble having been created in the first place.
True.
Listen, all of this stuff takes quarters and if not years before you see what the end result is going to be. Right now, we're in the glory heydays. They're building stuff. Everyone's like rah, rah, rah. But again, where's the money at? Right? How about the cell phones, right? When the cell phones
was
came
just
out
thinking that.
and everyone was talking about, oh, we're going to get more and more revenue per user, more like the AT&Ts, all the service providers thought, oh my God, we're going to put more services, we're going to get more money. What happened? It's the cost per month, the revenue per user, average revenue per user, ARPU, has been steady or going down month after month, year after year. It's not like they're making more money because there's more competition, so they're forced to compete and bring their prices down. They're forced to provide more services
But they're
for
still
less
profitable.
money.
But they're still profitable.
Profitable, but not to the extent that everyone thought that they
No,
would
I
be.
know.
Yeah, but
look at 5G. Hang on. Look at the amount of money spent on 5G networks. Ask the carriers if they've made up all the money that they spent on 5G.
No, but I would argue,
come
I would argue that
To me, it's the same thing. I see a parallel.
The wireless companies
I see a parallel.
are middlemen.
Yes.
And middlemen are rarely where you can have a very robust, sound business model that generates healthy profits, but that's not where the big money is.
They wanted to get into data centers
But
and
that's not
and,
where. But
and
they
services,
can't. They can't compete.
and they weren't able to.
They can't compete.
to me, the AI guys are going to be in a similar kind of position where they're going to be trying to offer services, and those services are going to be paid subscription services, and there's going to be a race to the bottom because there's going to be so many options available where you can have a Claude, an OpenAI, a Grok, whatever name you want to call of an AI agent or service that you have, and you're gonna be able to choose from a dozen of them. And why would
Well, let's take it a step further. Let's take it a step further.
Okay.
Because
But
when we talk about OpenAI, Oracle, Microsoft, Alphabet, Meta, and so on, it might be clear in their minds the type of business models they want to establish. Okay. And I would argue that all of those companies and a few others play by a similar set of rules. But if the Chinese truly are in a leadership position,
yeah,
and their service providers come to the table, and they're not looking at the next quarter or the next year or the next 3 years.
yeah,
They're looking a generation out, or maybe 2 generations out.
Yeah.
And they say, here's our service.
For
It's
free.
as good or better.
DeepSeek.
And guess what? It's a fraction of the price
Or
of what these North
or it's
American
free.
providers.
DeepSeek.
Or
Look what,
it's free.
look what DeepSeek did.
Yeah.
Right? And if they do that, exactly. That's exactly my point. Whether the Chinese go in and do it or whether it's just because of competition, I'm just saying it's going to be a race to the bottom from the services side. So you've got an infrastructure that's being built. You've got service providers that are going to be using that infrastructure to provide a service. And then you've got the consumers on top that are going to be paying.
Okay.
Sorry for my hands all over the place, but you can.
So let's switch gears.
Okay.
Let's switch gears. So like with any bubble, I think we have concurrence around this table at least that we're in a bubble. Like with any bubble, there's a lot of money to be made.
Oh, yeah.
And at some point, there will be a lot of money lost.
Yes.
A lot.
Yeah, it's a pyramid scheme.
And you can't time the market,
Well, you can try,
right? Well,
but be careful.
well, there's a human trait called greed,
Yes.
which gets in the way of people making rational decisions.
Correct.
So up until now, and some will argue for the next several months, perhaps 12 to 24 months, there's still likely maybe a window of opportunity to get atypical returns, high returns
Yeah.
on your investments.
Yep.
Then what?
Yeah.
And here's the thing that always gets me, and I'd say it registered with me for the first time at the time of the .com bubble bursting, is the degree to which a lot of this money that is invested
Is borrowed.
is borrowed.
Yeah.
It's margin.
Exactly.
It's a lot of margin.
No, but
And
you're
what
right.
happens when the bubble bursts?
Margin calls.
Yeah, and people losing their
And
homes.
people will lose everything.
Well,
But aren't there rules around margin calls?
No.
Aren't there limits?
no,
yeah, the limit is how much you have
how
as
much you
collateral.
have. Yeah.
Yeah,
But the thing is that when you buy a stock, the most you can lose is the price of that stock. But when you short a stock, there's no limit how much you can lose.
Well,
but,
no,
beyond, but beyond that,
beyond short-
So let's use numbers for the sake of example. So if I have $100,000 to invest, and against that $100,000, I can borrow $50,000. So I now have $150,000 invested.
It's 50%.
That 150 in the span of a year grows to 300. My capacity to borrow has just gone up.
Yeah.
And as the market continues to grow, my capacity to borrow improves.
And if you use that capacity,
When a collapse occurs, when a crash occurs, it occurs with very, very little notice and very quickly.
yep, it's an avalanche.
You have 48 hours within which to settle your debt.
Yep.
So if my original 150,000 has grown to 600,000, but of that 600,000, 200,000 is borrowed money.
Yeah.
In no time at all, I'm talking within 24 to 48 hours, my 600,000 goes down to 300,000. I still owe $200,000. I have 24 to 48 hours
To settle.
to settle. And if I don't, the financial institution
Yeah.
They'll sell your stock.
has the ability to sell your stock
Yeah. to get
in
the
order
money.
to pay itself back.
Okay, but you have to. But in the example that you gave, you have to have a reserve. You have a
there's no
cushion.
What reserve?
So
Your what is it like? If you're $150,000
On the way
account,
up, on the way
account,
up, you do. So there are ratios
Right.
that have to be maintained. The moment
That's what I'm
that
asking.
ratio is not where it needs to be, it
Right.
falls below the threshold.
yeah.
You are immediately obligated to pay money back.
Yeah, it's either 50 or 70%.
And now you're going to sell
Yeah.
stocks at a
loss.
because
Right.
you didn't on the way up, you didn't you made money on the way up, but on the way down, you're going to have some of your equity that is trading below your latest purchase price.
so you're not able to cover your losses.
No, you are able to cover your losses.
Okay, that's what I'm saying.
But you're going to lose not only the money you borrowed, you're going to lose
Yeah.
the value of your initial
Yeah,
investment.
you're gone. You're
Because on the
You
way
may
up,
lose more.
Because on the way up, you make paper money.
yeah.
I mean, money on paper.
Yeah.
On your way down, you lose real money.
Okay, because I thought that there was from a long time ago, from the Great Depression, because that's what happened with the margin calls. People just absolutely
same thing.
but it hasn't
No,
not
they-
been the
Yes,
threshold.
yes.
the
What they
threshold
did
now.
is they changed the so
Right.
if I used to be able to borrow $1 for
Yeah.
every dollar I
Yeah,
had,
exactly.
That's
now
right.
now I can borrow 50 cents for
Yeah,
every
it's
dollar.
It's
I have.
actually
okay.
70 cents
Okay.
for most stocks.
Okay. Does that not
I think it depends.
Does
Depends
that
on the
not
stock.
contain? Does that
Not
not
the
con-
ones most people are chasing today.
Right.
Well, so yeah.
Try.
The better ones are 70 cents. The other ones are 50
So for the
cents.
margin calls, does not kind of that contain the damage a bit, or no?
No, the problem of a margin call is you have to sell. The
Yeah.
call means the bank wants its money back.
Right.
But the time that they need the money back is when the stock valuation went so low that you went through below the threshold. So now they're going to sell the stock at the cheapest price. So you're losing money. You're losing tons of money.
They know from history that if they leave you with the borrowed money, you're going to ride it out until you've lost your money
Yeah.
and their money.
And the bank's money, exactly.
So they want their money back.
Right.
They'll be okay with you losing your money.
Correct. So they're not going to be. So they're not going to be. Yeah, but they're not going to be in jeopardy because at
No,
least
they will have bad debts. They will lose
right,
money,
right.
but they will recover most of the money that's owed.
Okay, that's what I'm saying, and that is a bit of a safeguard.
And
Is it not?
remember,
For the bank, not for
For
you.
the bank, not for the individual. I'm talking
No.
about the bank. I'm talking about the institutions. At least don't go under.
Okay.
At least you have still a functioning market.
Yeah, I know.
a
But what's
severely damaged one.
what's
Yeah.
going to happen? So it's gonna destroy a lot of people. and their
Absolutely,
lives,
for
right? Because
individuals, massacre.
and the problem with the way things have been going for the past whatever 10 since 2009 minus COVID is that markets have always gone up. So there aren't that many investment professionals that have been around long enough to understand what a down market is. Everyone thinks the market just goes up and
scary.
continues to go up.
That's
But everybody, whether there are or there aren't, they're all in the same business.
Yeah, and they all want to. They're in the
gonna
business to
sell
sell.
you. Exactly.
So right now, the best non-advice, because we don't provide financial advice on this call, but I mean, I've been trying to get as much into cash as possible.
Well, and diversify. Like the other thing we didn't really discuss, we kind of talked around it, is you have a lot of people who are putting all of their money, in 5 companies, 5 businesses, or fewer.
And to Dominic's point, there are companies that'll be less affected by this AI bubble.
Okay, so I find that so the institutions, the big hedge funds, right? Yes. They're that at that level of a herd mentality. They just run and invest mostly in these big companies. Like they don't diversify
sometimes
enough
you have
to
to.
diversify their risk.
Sometimes you have to. If you have an S&P 500 SPY, for example, they have to actually invest in the same ratio as a company has with respect to its valuation in the S&P 500.
Let's not kid ourselves. So will large institutions be hurt? Of course. Some large institutions will be badly hurt, others less so. But the retail investor is going to get killed.
Yeah, like bloodbath. And what's going to happen to the economy then, when no one can spend any money and 70% of the U.S. economy is consumerism?
Or 401ks.
Yeah.
That's
exactly what I'm
in the
thinking.
U.S., like people's retirement money, suddenly say, oh, you know what? I'm in pretty good shape. I'm 65 years old and I've seen my 401k grow to $3 million.
Yeah,
well, what if that
exactly.
$3 million was less than $1 million?
Yeah, exactly. And you
no
have to
longer
retire.
have the same opportunities.
Yeah, exactly. There's a lot of shit can happen from a bubble bursting, and the scary part is over the past 2 years, the market's up, I don't know, 40, 50%. If you go compounded, I think it's over 50%. And again, this is market-wise. It is NASDAQ, for example. Individual stocks, some have tripled, some have quadrupled, right? Depending on which stock. So there's a lot of people who feel really good about the money that they have, whether it be in their 401k or in their other accounts, and the fact that they feel a lot wealthier. And
well, on paper, use dollar cent, they are wealthier.
They are, and they'll be more willing to spend on vacations, on cars, on whatever.
But if they've done things right, if they're diversified properly, and
that's a big if, my friend.
Okay, so I imagine
not everyone.
What most investors are not at that level. Most investors
most investors are not financially savvy.
No, and
they follow the trend line.
Okay, so you have $1 million to invest. You've let's say 3 years ago, you invested 20% in tech, 10% in energy,
financial services,
Yeah. That year,
healthcare.
You saw tech triple.
Yeah.
Everything else stayed about 5% to 10% or less. The next year, what are you going to do with your investments when you see tech triple? The next year, you put more into tech. Well, now instead of 20%, you put 40%. Hey, tech tripled again. Over time, everyone is seeing
it's greed. It's
right.
greed.
So that's right. So if people are chasing the trends, of course, that's what it's all about. Of course. I just thought at this point,
and there's a lot of stock picking going on. A lot.
Okay.
And most people are not qualified.
I just thought, guys, I thought that the big institutions and the most influential, players that manage the 401ks, that manage the retirement funds, are more astute. That's all that I'm saying.
Well, that manage the 401.
So more astute. Warren Buffett, I think, accurately stated well over a decade ago that fewer than 10% of professional money managers can outperform the market.
Yeah.
Fewer than 10%.
Yeah, the S&P 500. Very difficult to outperform.
Actually, when you diversify, you're accepting a lower return.
Exactly.
Yeah.
So
but at least you have stability.
The best way, you talk about diversification.
No?
Yeah.
The best way to invest, really, if you're going to look at equities, would be to buy the market.
Yeah, SPY, NASDAQ. I like those two.
Index funds.
Well, QQQ and SPY.
You buy the S&P, like an ETF that reflects the S&P 500.
Yeah.
And you may have a few years where you don't perform as well as others, but over the long term, you're going to be fine, because over the long term, the financial markets only move in one direction.
Yeah, exactly.
And by the way, if you're 65, don't invest like you would have when you were 30, because if you make a mistake at 30, you have most of your adult life to correct a mistake.
Yeah.
At 65, you're playing with your retirement.
Exactly.
And let's not forget what the famous economist Kenneth Galbraith said: in the long term, we're all dead.
I'm not happy. Wow.
And he was such a stoic person. And when he was asked that question, that's what he answered.
Good way to respond.
Okay,
so
on that cheerful note,
Thank you, Dominic. We're open the bar.
Final thoughts, Naren.
Well, I definitely feel like we're in the beginning or in the middle or near the end of a bubble, but there's some bubbles in me, and it's not just my my stomach wanting to fart.
Very deep, Naren.
So I think that the just the lessons learned in the past about services and about the lack of ability to monetize on the service level to end customers. Maybe business is better than end customers, but for end customers or consumers is going to be a challenge. And I'm not certain that the return on investment is going to be viewed anytime soon over the next, let's say, 2 to 3 years. And because of that, I think shit's going to hit the fan at some point.
Yeah, I think there is a bubble, but I strongly believe it's not a bubble across the board. I think some companies will come out big winners, some will come out as big losers, but it won't be across the board.
Okay. So I was inclined to think before this podcast that there was a little more sanity and that we've learned from our mistakes and there's more responsible investment going on. And I see everybody shaking their heads. So that goes out the window. So it's all a crapshoot.
Yes.
We're done.
It's always been that way.
That's the market.
Yeah, and I think just to add a couple of thoughts to your comments, what's clear is you can't time the market. It's impossible. You know, there may be some coincidences, there may be some luck involved, but you can't consciously time the market. So recognize what it is. If you've made a lot of money, congratulations. Be careful. If you haven't made a whole lot of money yet and you feel you've been overly conservative, be careful.
Yeah.
And regardless of what your situation is, consider the stage of life you're in and the degree to which you really can afford to make mistakes with the money that you're going to require to live a full and rewarding life.
I know. That's
Well said.
Be cautious. All right, guys,
great
enjoyed
point.
the conversation.
Yep. Same
Yes.
here.
Be interesting to follow this one over the course of the coming months and quarters.
Yep. Let's have a follow-up.
On that note, to our viewers and listeners, thank you for joining us.
And subscribe.
Don't short the stock.
See everyone next week.
Take care, guys. Bye.
Bye.